Hey there, fellow investors. Today I want to talk about a stock that used to get bombarded with questions back in 2019, but now nobody seems to care about. Yep, you guessed it. It's Diageo, or however the heck you pronounce it. Sorry, I'm still trying to figure that out myself. Back when the stock was on the rise, I couldn't escape the flood of inquiries about it. But now, after a few stagnant years, I've got zilch, nada, zero questions about it. Quite fascinating, isn't it? Especially considering that the company has been steadily growing, raking in an extra $2 billion in revenues and boasting iconic brands like Johnny Walker, which, by the way, is also the name of my dog. Or should I say my former dog before we changed it to Peps? Long story. You'd think all this would make it a good business, right? Well, sure, it probably is. But here's the twist. They're now going all in on desire. That's right, the age of desire is upon us. It's like they're building a business model based on fulfilling people's cravings. Not exactly your typical value investing strategy. But hey, it's all about growth, baby. And that's what gets the stock market all hot and bothered. But here's what caught my attention. Minimal buybacks before, then a sudden obsession with buybacks. It's like they're playing hard to get with those shares. And you know what usually happens with businesses that do that? Let me show you. Here's the idea stock graph. No buybacks, then some big buybacks, and now even more buybacks as the stock keeps soaring. It's as if they believe they'll keep growing forever. Well, they're paid to think that way. But as an investor, it doesn't quite tickle my fancy. So I've come up with my own little investing quadrant called the Carlene Venue Investing Quadrant. Let's throw Diageo into the mix and see where it lands. As for the risk, well, I'd say it's a tad higher due to their obsession with the desire-based business model. And as for the reward, with a PE ratio of 20, it's somewhere in the middle. Not too shabby, right? But keep in mind, I don't really know much about their alcoholic concoctions since I don't drink. But hey, I'm sure many of you are interested, so there's that. So if we plot Diageo on the quadrant, I'd say it leans towards higher risk, but with potential for medium-ish market-like returns. Just to give you a comparison, we recently talked about Shell. And boy, does that one have some risk due to the oil market roller coaster. Personally, I'm not a fan of Shell, so it lands somewhere down here in the quadrant. But Diageo is definitely a step up from that. Now don't get me wrong, investing in Diageo could still be a solid move. It's a good business in an interesting market. You probably won't go broke if you invest in it, but don't expect fireworks either. You know us investors, always chasing low-risk, high-reward businesses. So, Diageo falls somewhere around here.
Thanks for tuning in, folks. Don't forget to check out my research platform, and I'll catch you in the next video. Happy investing, and may the financial forces be with you.